Hey guys, I hope you all are doing great. So, welcome to the next episode of the Audit Practically series. So, if you're onto this channel, if you're someone who's new to this channel, let me just give you a perspective of what we do as a part of this series. So, by the way, I'm Aravind, I'm a chartered accountant. So, in this series, we discuss from start to end on how a financial statement line item is audited in the real world. Like, for example, let's take something like a property, plant, and equipment. Obviously, all of us would have studied the accounting standard in relation to the same, be it your AS10 or your Ind AS 16. And as a part of our audit subject, we would have also studied how the same is audited. But when it comes to the real world, there are certain practical difficulties and certain nuances that need to be taken into account while doing the same. So that is what we discuss as a part of this series. So this series would be really helpful for someone who is starting out their articleship in the stat audit domain, or someone who's a qualified CA and who's starting out their work experience in the stat audit domain, or someone who's even curious to know what happens in the stat audit domain practically, right? So guys, what are we waiting for? Let's deep dive into this. So today we're going to be looking at managerial remuneration on the similar lines. So sit back, relax, and enjoy as we dissect this one, right? Guys, what is managerial remuneration? So loosely speaking, managerial remuneration is the remuneration that you basically pay to your directors. So basically, this remuneration has a maximum limit, and that limit is based on your net profits, right? So basically, you would have a doubt: what is net profit? Is it the profit that is appearing in your profit and loss account? To an extent, yes, but not really. So to the profit that is appearing in your profit and loss account, you need to tinker it a bit and make certain changes to make it in line with what the section says. So your net profit is discussed as a part of your section 198 of the Companies Act 2013. So we need to take our profit as per our profit and loss account, and we need to tinker it a bit to suit the requirements of section 198, and we are ready to go and we are ready to calculate the maximum limit. And after calculating the limit by applying the percentage that is specified in that section, we need to compare whether the remuneration that we have paid to our directors is within this limit or not. It's as simple as that, guys. Some of you might have a doubt as to why does this segment even deserve an exclusive video? Like, what is so important in this? This looks straightforward. This looks straightforward, but it is tricky. And this segment deserves a separate video because it forms a part of your main audit report. And anything that forms a part of your main audit report has to be taken with a lot of seriousness, a lot of diligence, right? So that is why we are making an exclusive video on this, right? So what are you waiting for? Let's deep dive right now. And with all the preview being done, let's go into the section and dissect this. Let's go into section 198 and see what section 198 talks about in relation to net profit computation. Yes. So what does the section say? Let's just start reading the Bar Act. I have the Bar Act in front of me because that is how you get to know what is actually said. You are able to interpret in the true sense. You're able to read the spirit of the law when you read right from the Bar Act, and you need to read every single word because every single thing matters in arriving at a conclusion, right? So yes, so here we go. Calculation of profits. In computing the net profits of a company in any financial year for the purpose of section 197. So what is section 197? So section 197 is basically the section that discusses about the limit for managerial remuneration. Section 198 tells you how to compute the profit to apply the limit in order to compute the maximum permissible managerial remuneration. Credit shall be given for sums specified in subsection 2, and credit shall not be given for the sums specified in subsection 3. So basically they are saying that we have to give credit for sums specified in subsection 2, and we should not be giving credit for items specified in subsection 3. That is what they are saying. So here, in computing the net profits of a company, you will have a very simple doubt here. Should we start with the net profits of the company before tax in our P&L, or should we start with the net profit after tax in our P&L? So that is what I've written here saying. Section 198(5)(a) clarifies that it is net profit before tax, which is the starting point. Let's just move down to 198(5)(a) and understand why it is net profit before tax, right? So if we just come to 198(5)(a), in making the computation aforesaid, the following sums shall not be deducted: income tax and super tax payable by the company under the Income Tax Act 1961, or any other tax on the income of the company not falling under clauses D and E of subsection 4. So from reading this, you understand that your net profit before tax ought to be your starting point, which is very clear, right? Yes. So we will start with this and we will make some alterations. We will add some items, we will subtract some items and arrive at the net profit as per section 198. I hope it is very clear, guys. Now on to the section. So the sum specified in subsection 4 shall be deducted, and those specified in subsection 5 shall not be deducted. We'll just keep this in mind. When we come to subsection 4 and subsection 5, we'll just apply the items outlined here, right? In making the computation aforesaid, credit shall be given for the bounties and subsidies received from any government or any public authority. Okay, so basically what they're saying is, suppose if this item is already not taken as an income in your P&L, this has to be added to your net profit. Let's say there is 100 of credit that is given given by the government. It is already taken as an income in your P&L. You don't need to add it again because it is already included in your net profit before tax, which is your starting point, because you have already taken it in your income. I hope this is very clear, guys. In making the computation aforesaid, credit shall not be given for the following sums, namely. So basically, if this item had been taken as an income already in your P&L account, you would have to remove it. That is what it is trying to say. Or if this item had not been taken as an income, you don't need to do anything because it's not even been considered as an income in the first place. I hope that is very clear, guys. Profits by way of premium on shares or debentures of the company which are issued or sold by the company, unless the company is an investment company. So basically what they are trying to say is your securities premium should not be included while arriving in your net profit. Obvious, you don't take your securities premium in your net profit. It is a separate reserve, right? That is very obvious. So you don't need to do anything here because it is not even included in the net profit here. So you don't need to remove it. Only when something is included will you remove it. I hope that is very clear, guys. Next, profits on sale by the company of forfeited shares. Again, similarly, this will go to your capital reserve. So this is no way going to be impacting your profit and loss account, right? So again, your forfeited share sale is not going to be impacting your profit and loss account. So you don't even need to remove this because this is not even going to be included in the first place. Suppose it had been included, you would have to remove it, but it's not included, so you don't need to remove it. I hope it is very clear, guys. Next, profits of a capital nature, including profits from the sale of undertaking or any of the undertakings of the company or of any part thereof. So what they're saying is if there is any profit of capital nature, like your sale of undertaking, that would have obviously gone into your profit and loss account as a profit, as an income. You would need to be removing it here for the purpose of the computation under section 198. That is what this is saying. I hope it is very clear, sir. Next, profits from the sale of any immovable property or fixed assets of a capital nature comprised in the undertakings or any of the undertakings of the company, unless the business of the company consists, whether wholly or partly, of buying and selling of any such property of assets. So basically what they're saying is you have to remove the profit. But however, if the business of the company in itself is buying and selling the assets, like for example, a real estate dealer, you don't need to remove that from your profits in that case. That is what this is saying. And this point, provided that where the amount for which any fixed asset is sold exceeds the written down value thereof. Basically, you're selling the asset at a profit. That is, you're selling it at above the written down value. Credit shall be given for so much of that excess as is not higher than the difference between original cost of that fixed asset and its written down value. So basically, this is the heart of the discussion, guys. I will not be discussing this point right now. I will be correlating this with another point and I will be discussing it few minutes down the line. So just park this aside for now, right? Yes. Next, any change in the carrying amount of an asset or a liability recognized in equity reserves, including surplus in profit and loss account on measurement of the asset or liability at fair value. So basically, when you have the fair value change in asset, let's say you are taking an asset at FVTPL, fair value through profit and loss account, as per your Ind AS 109. At that time, what would happen is, let's say you have a gain on that asset. So that gain would be recognized in profit and loss account and it would be included in your net profit. But guys, think logically. Is this gain an actual gain? No, it's a notional gain. So ideally, when you're computing your profit, this would have been included in your profit and would have inflated your profit. Since it would have inflated your profit, when you apply the percentage that is permissible as remuneration to the directors, you're giving the profit out of an item that is notional nature, which is not right. Hence, you're removing the same. I hope that is very clear, guys. Yes. Next. Any amount representing unrealized gains, notional gains, or revaluation of assets. Guys, again, if you see here, they are referring to your unrealized forex gain. So when you have a forex gain, when you have a monetary item as per your Ind AS 21, at that time what would happen is you would be measuring the same. You would be measuring the same, and you would get a forex gain or loss. Let's say you get a forex gain. Again, since the item is not yet been realized, it would be a forex gain that is unrealized in nature. Again, this would have gone to your profit and loss account as an income. But is it actually an income? No, it is not. It is again notional in nature, which is why you have to remove it while calculating the net profit under section 198. That is, you have to deduct it. I hope that is very, very clear, guys. Yes. Next. In making the computation aforesaid, the following sums shall be deducted normally. All the usual working charges. Obviously, this would have already been deducted. Director's remuneration. Then your bonus or commission paid or payable to any staff, etc. This would have again already been deducted. Obvious, right? Next, any tax notified by the central government as being in the nature of a tax on excess or abnormal profits, any tax on business profits imposed for a special reason. So this is theoretical in nature. This is not practical because we don't have any tax like that from what I know. Because you only have your Income Tax Act 1961 tax on your income, right? Next, your interest on debentures issued by the company. Obviously, this would have already been reduced. Next, your interest on mortgages executed by the company. Again, this would have already been reduced as a part of your finance cost while arriving at your profit as per your profit and loss account. Again, your interest on unsecured loans and advances. Obviously, this would have already been reduced again. So you don't need to do anything again because it's already been removed. Next, expenses on repairs, whether to immovable or movable property, any expense would have been reduced again while arriving at a net profit. Outgoings inclusive of contributions. Again, your contributions you make under section 181 would have already been reduced as an expense. Depreciation to the extent specified in section 123. Obviously, your depreciation would have been reduced in arriving at a net profit specified in section 123 because section 123 it gives you the reference to a schedule in Companies Act where you have the useful lives of the assets. So you can either follow the useful lives of the assets set out in Companies Act, or you can follow a useful life that is different from that set out in Companies Act, provided you do a technical evaluation and you're able to justify that the useful life you have taken is actually reflective of the useful life of that asset. So every company will do a technical evaluation because in some cases their useful lives would not align with the useful lives set out in the Companies Act schedule. So in such a scenario, what would happen is your depreciation would ideally be in line with your section 123, and you don't need to do any adjustment in relation to this because your depreciation appearing in your P&L is already in line with the schedule basis the technical evaluation done, and it has already been reduced. You don't need to do any adjustment here. I hope that is clear. Next, the excess of expenditure over income which has arisen in computing the net profits in accordance with section in any year, insofar as such the excess has not been deducted in any subsequent year of which the net profits have to be ascertained. So this is omitted, guys. So this is not in force right now. Yeah, and if you, in case you want me to explain this, you can just comment down below. I'll maybe write it down in the pinned comment as to what they're referring here. Next, any compensation or damages to be paid in virtue of any legal liability, including a liability arising from a breach of contract. So they're referring to your liquidated damages here. So again, this would have already been reduced. So you don't need to reduce it again. I hope that is clear. Debts considered as bad and written off or adjusted during the year. Again, your bad debts written off is obviously an expense. It would have been reduced in arriving at net profit. So you don't need to do anything. You just need to sit back, relax, and enjoy, right? That's it. You don't need to be doing anything here. Next, in making the computation aforesaid, the following sums shall not be deducted: income tax and super tax. As we saw here, that is why you start with the net profit before tax and not with the net profit after tax. Next, any compensation, damages, or payments made voluntarily, that is to say, otherwise than in virtue of a liability referred to in clause M of subsection 4. So basically, we are saying any compensation in virtue of any legal liability. So basically, what they're saying is if you are making any payment voluntarily, that is other than the item referred here, you have to add it back because you have deducted it while arriving at a net profit. You will have to add it back, right? I hope that is clear. Next, loss of capital nature, including loss on sale of undertaking or any of the undertakings of the company or of any part thereof, not including any excess of the written down value of any asset which is sold, discarded, demolished, or destroyed over its sale proceeds or its scrap value. Again, this is again connected to your gain point in relation to your assets which we had discussed above. So we will be discussing this separately in the next few minutes. And then after we discuss this, if you're able to read this, you will be able to relate what the section is actually trying to say, right? Yes. Next, any change in carrying amount of an asset or liability recognized in equity reserves. Again, this is your, let's say you are holding an asset at fair value through profit and loss account. Let's say there is a loss on that asset. So what would have happened while arriving at your net profit as per your profit and loss account, you would have reduced it. But again, it is notional in nature because it is a treatment that is required by the accounting standard. It is not an actual loss. So you add it back. Right? That is what they're saying here. I hope that is very clear, guys. Yes. Okay. Now let's come to the heart of the discussion. This is the most critical part in section 198, which many clients tend to make a mistake in while giving you the computation. So you need to be really careful around this part, and let's discuss this, right? PP sale scenarios. Okay. Let's take the first scenario. Let's say the asset is sold for a loss. Let's say the return on value of the asset is rupees 10. Let's say the selling price is 7. Obviously, there is a loss of rupees 3, which would have been booked in the P&L, right? Under your operating expenses, or shown as a negative item in your other income, whatever the case might be. For section 188 computation, don't add it back as it is routine in nature, right? Yes, I hope this is clear. Let's come back to what the section is saying. So it is saying loss of capital nature, including loss on sale of undertaking or any of the undertakings of the company or of any part thereof, not including any excess of the written down value of the asset, which is sold, discarded, demolished, or destroyed over its sale proceeds or its scrap value. Yes, again, here it is saying that you don't need to add it back. That is what they are referring to. Okay. Next, let's come back to asset sold for profit. Let's say the original cost of the asset is 10. Let's say the written down value is 4. Let's say the selling price is 6. So what would be the profit? Please don't say that it's a loss by looking at original cost of 10, selling price of 6, right? No, it's not a loss because you have sold the asset over and above the WDV. Your WDV is 4. You have sold the asset at a selling price of rupees 6, right? So you have sold the asset at a selling price of rupees 6. So it's a profit of 2 that will be included in your profit and loss account. For section 198 computation, don't remove this Because this is the recovery of depreciation. Because already directors got lesser remuneration in the past because of depreciation deduction with respect to this asset. Because what would have happened? Because you have a profit here, and that profit to the extent of 2. Like let me explain this even in a simpler manner. So let's say your original cost is 10 here, right? So your WDV is 4, your selling price is 6, your profit is 2, which is included in your P&L. So it is saying that don't remove this profit because this is a recovery of depreciation. How is this a recovery of depreciation? Let's take this. Your original cost is 10, your WDV is 4. It means what is the depreciation that has been applied on the asset throughout its life? A depreciation of 6 has been applied on the asset, right? Because 10 minus 6 will yield you a number of 4. That is very clear, right? So this 2 is less than 6. So basically this 2 is a recovery of that 6, right? That is what they're trying to say. Since the 6 would have already been deducted in the previous years, the directors would have got a lesser remuneration. Again, if you deduct this 2, it will be like a double deduction and the directors will lose out on the remuneration. So that is why Companies Act is saying that if you have a profit over and above this, in the sense key, if your profit is exceeding 6, that is if your profit is exceeding the recovery of depreciation, the differential of the excess that should be deducted, not the entire thing, right? I hope that is clear. However, if selling price is 11, let's say the selling price is 11. If the selling price is 11, what would have been your profit, sir? Your profit would have been selling price of 11 minus WDV of 4. You would have got a profit of 7. But as we saw here, your depreciation was only 6, right? We saw that your depreciation throughout the life of the asset was rupees 6, but your profit is 7. So what would have happened is you have recovered your depreciation because your profit is 7. 7 is greater than 6. You have recovered the 6. That is very obvious, right? So the 1 which is an excess, that should be reduced in arriving at your net profit. I hope it is very clear. The 1 should be reduced in arriving at your net profit. Here you don't need to do anything here because the profit is already included. You don't need to do an adjustment because 2 is less than 6. But here if you see, the profit of 7 is greater than 6 to the extent of 1, which you need to reduce. You need to remove that 1 from your net profit because this is over and above your recovery of depreciation, right? I hope this is very clear, guys. Yes. And one more point which I want to be stressing on is your loss of capital nature. So your impairment can be construed as a loss of capital nature. But what would happen is, I will give you a perspective. Maybe I'll discuss this through towards the end of the video where we will have our take on CSR as well. It'll be better if I discuss that there instead of discussing it here. So again, let's just park that for a while and let's just come back. We'll come back. Don't worry about that, guys. Every point we've been saying we'll come back. We have been coming back to it. So don't worry about that. Right? Yes. Now let's come to section 197, which says how much is the maximum managerial remuneration. So the total managerial remuneration payable by a public company, read it very carefully. It's not applicable to a private company. So very, very clear, guys, to its directors, including managing director and whole-time director and your manager. So guys, your managing director, whole-time director and manager are defined in your Companies Act. You can look at the definition if you want. And if I have to just give you something for your general understanding, I'm sure some of you would have read CA Final Law would know this. A company cannot have a managing director and a manager at the same time because both of them are extremely powerful people. Your company cannot have such a combination. You can have a managing director plus whole-time director. You can have a whole-time director plus a manager, but you can't have an MD plus a manager. I hope that is clear. Just keep that in mind. In respect of a financial year, shall not exceed 11% of the net profits of that company. So basically, we saw above on how to compute the net profits. So that net profit which you're computing into 11% should be the maximum remuneration that is permissible to your to your directors. So basically here to its directors, including managing director, whole-time director, and its manager, right? So your maximum remuneration cannot exceed 11%, right? So that's what I've written here saying total managerial remuneration less than or equal to 11% net profits under section 198 plus remuneration to your other directors, because your directors includes your other directors as well. For example, you might you might have an executive director, so it includes to him as well, to its directors. It's only saying including managing director. It's not saying excluding your executive director or anything like that, right? So that is that. And next it is saying that for that financial year computed in the manner laid down in section 198, except that remuneration of the directors shall not be deducted from the gross profits. So above, if I just go to section 197, it is saying the following sums shall be deducted directors remuneration. But here, if I just come down to section 198, it is saying that yes, you do everything that is said in 198 for arriving at the net profit, but you add back the director's remuneration that you have already provided for in your P&L. Like let's say you have taken a P&L charge of 100 in relation to director's remuneration, add back that 100 in arriving at the net profit as per section 198. Because it would have already been reduced, you add that back. That is what it is saying. I hope it is very clear, guys. Then on that you apply the 11%. I hope that is clear. Yes. Because what the section is trying to say is, if I had not paid remuneration, because the net profit in a P&L will be after paying the remuneration, right? It is trying to say that without paying remuneration, I would have had a surplus of funds, right? Because after paying remuneration, my profit is getting reduced. I want to find out how much maximum I can pay, which I will only know when I take the profit before the remuneration, right? Because only when the remuneration is not yet paid can I understand that how much am I allowed to pay, and I can compare with that with how much I've already paid. I hope that is very clear, guys. Yes. Next. Provided that the company in general meeting may authorize the payment of remuneration exceeding 11% of the net profits subject to the provisions of Schedule 5. Yes. Provided further except with the approval of the company in general meeting by a special resolution. Let's say your net profit comes to rupees 100 in accordance with section 190. Let's say you apply 11%. So you can maximum pay a remuneration of 11 rupees, right? But let us say what has happened is you've paid a remuneration of 12 rupees. What is to happen is you have to get the approval of your members in your general meeting by passing a special resolution. So when a special resolution is passed and your members agree to the same, only then will the 11 be allowed. So this will have an impact on your audit report language wording, which again we will discuss towards the end, where I'll be explaining you what implication does this have on the audit report. I hope that is very clear, guys. Next, we saw that 11% is the overall limit for all the directors, but this 11% is broken down into specific limits. Let us discuss the specific limits one by one, right? I hope that is clear, guys. So the remuneration payable to any one managing director or whole-time director or manager shall not exceed 5% of the net profits of the company. And if there is more than one such director, remuneration shall not exceed 10% of the net profits to all such directors and managers taken together. So let us say my company has only one MD or one WTD or one manager. Out of these three, there's only one in my company. So the maximum I can pay to that one person is 5% of net profit under section 198. However, let's say there is a scenario where I have an MD and a WTD in my company. Or let's say there is a scenario where I have a whole-time director and a manager in my company. Then the maximum I can pay to these two people put together cannot exceed 10%. So when there is more than one person, I have to look at the threshold of 10%. When there is only one out of these three, I have to look at the threshold of only 5%. I hope that is very clear, guys. Next. The remuneration payable to directors who are neither managing directors nor whole-time directors. Like for example, there is commission for some of your directors in the company. That cannot exceed 1% of the company if there is a 1% of the net profits, if there is a managing director or a whole-time director or a manager. 3% in any other case. So for example, let's say I have other directors in my company. So the maximum I can pay to them is 1% of net profit. Like let's say my net profit is rupees 100. The maximum I can pay to the other directors is rupees 1 only. However, let's say my company does not have any MD, does not have a whole-time director, or does not have a manager. In that scenario, I can pay 3% of 100, that is rupees 3 to these other directors, right? Because basically, why am I getting a higher percentage, higher leverage here? Because I don't have other directors, so I can afford to give, I don't have the MD or WTD or manager. In such a scenario, I can afford to pay 3%. I can afford to pay a higher percentage because there aren't other people waiting for the share. That is why there is a higher percentage of 3 here, but there is a lower percentage of 1 here. I hope that is very clear, guys. Yes. Next. Provided that when the company has defaulted in payment of dues to any bank or public financial institution or non-convertible debenture holders or to any secured creditor, the prior approval of the bank or PFI concerned or the non-convertible debenture holders shall be obtained by the company before obtaining the approval in the general meeting. So basically, when you have a default, you have to these people, you have to obtain their approval as well, right? So that's what they're trying to say, right? Next, the percentages aforesaid shall be exclusive to any fees payable to directors under subsection 5. This is very, very important, guys. So what they are basically saying is there is a concept called sitting fees. So what is sitting fees, guys? Basically, your directors are people with years of expertise, years of knowledge, years of experience, right? So they will be attending your board meetings, your audit committee meetings, your stakeholder committee meetings, your nomination remuneration committee meetings, because they have years of rich experience, right? So when they are attending those meetings, you will pay an amount called sitting fees because they are sitting in that meeting, they are marking their presence in their meeting, and they are sharing their insights in the meeting, right? So this is something called sitting fees. So when you're taking the remuneration to the directors, like let's say you apply 11% of 100, that is rupees 11. Let's say the number that you have paid to the directors comes out to rupees 13. But out of this, what happens is rupees 10 pertains to remuneration, 3 pertains to sitting fees. Is it within the limit? Yes, it is within the limit because you should take 10 for the comparison with 11 and not 13 because the 13 includes a sitting fee of 3 which should be excluded. And when I do 13 minus 3, I get a number of 10 which is less than 11 which is within the limit. So this is perfectly permissible. So you just need to keep this in mind while doing the computation. I hope the example was very clear, guys. Next. Notwithstanding anything contained in subsection 1 and 2, but subject to the provisions of Schedule 5, if any financial year company has no profits or its profits are inadequate, the company shall not pay to its directors, by way of remuneration, except in accordance with Schedule 5. So basically, Schedule 5 talks about a concept called effective capital, where it says that if your effective capital is less than 5 crore, you can pay a maximum of this amount and per director per annum. So this is a very, very detailed discussion because we need to discuss the meaning of effective capital. We need to discuss these thresholds again, which I will cover as part of a separate video, because if I do it as a part of this video, it will become even more lengthy, which I don't want to happen. If you want a separate video on the practical implications of effective capital computation and inadequate profit scenario, just comment it down below. I will do the same as well, right? Next. The remuneration payable to the directors of a company, including any managing or whole-time director or manager, shall be determined in accordance with and subject to the provisions of this section, either by the articles of the company or by a resolution, or if the articles so require, by a special resolution passed by the company in general meeting, and the remuneration payable to director shall be inclusive of the remuneration payable to him for the services rendered by him in any other capacity. So basically what it is saying is that your articles of association can also fix the limit, but that limit which is fixed by your articles of association cannot exceed the 11%. Like let's say your articles of association can say that maximum 10% of the profits can be paid to your MD, whole-time directors and other directors put together. It cannot say 12% because your AOA cannot override the act, right? That is what they are trying to say here. I hope that is clear. And this remuneration shall include the remuneration payable to him for services rendered by him in any other capacity as well. That should also be included. And below there is an exception. Let's discuss that. Provided that any remuneration for services rendered by any such director in other capacities shall not be included if the services rendered are of a professional nature, and in the opinion of nomination and remuneration committee, if the company is covered under subsection 1 of section 178, or the board of directors in any other cases, the director possesses the requisite qualification for the practice of the provision. So, for example, let us say one of my directors is a registered valuer, and I pay him some amount in relation to the services he is providing in this regard. So this amount which I pay to him in the capacity of a registered valuer, that should not be included in the remuneration. Like let's say, for example, when I apply 11% of 100, it comes to rupees 11. But let's say I pay a remuneration of 13 to my director. Let's say out of this 13, 2 is for him in the capacity of a registered valuer. So if I remove that 2 from 13, how much do I have? I have an amount of 11 as remuneration, which is equal to 11, which is within the limit, right? I hope that is clear. But let us say the director is not a registered valuer with the Institute of Registered Valuers. Let's say he is merely a valuer who has experience in the valuation field, but he is not a registered valuer. In that scenario, what would happen is the 2 would have to be included, and you would have to compare 13 with 11, and you would have to say that the 13 is exceeding 11, it is beyond the limit, and a special resolution would be required in that case. I hope it is very clear. The services should be of a professional nature, and the director should possess the requisite qualification. Both are important. It should be professional nature, and there should be a qualification which is professional nature in this regard. Both are cumulative conditions. Just keep that in mind, guys. I hope that is very clear. Next, a director may receive remuneration by way of fee for attending the meetings of the board or committee thereof, or for any other purpose whatsoever as may be decided by the board. This is what we refer to as sitting fees. For sitting fees also, there are rules like in relation to the maximum limit, which we will discuss later on again. Next, provided that the amount of fees shall not exceed the amount as may be prescribed. Yes, this is what I was referring to, which we will discuss just a few minutes down the line. Next, provided further that different fees for different classes of companies and fees in respect of the independent director may be such as may be prescribed. A director or manager may be paid remuneration either by way of a monthly payment or at a specified percentage of the net profits of the company, or partly by one way and partly by the other. Basically, it's saying that your remuneration structure can be either a monthly payment or a percentage of net profits, or a combination of both. One portion is in relation to monthly payment, another portion is in relation to percentage of net profits. It can be a combination of both as well, or it can be either of the two. All right, I hope that's clear. Next, net profits for this purpose of the section shall be computed in the manner referred in section 188. Yes, that is right. We saw that. Next, if any director draws or receives directly or indirectly by way of remuneration any such sums in excess of the limit prescribed by the section, or without the approval required under the section, he shall refund such sums for the company within 2 years or such lesser period as may be allowed by the company, and until such sum is refunded, hold it in trust for the company. So what they're saying is, basically we saw the example, right? Like where the maximum permissible was 11, but the director got 13. So if the members approve this in the general meeting via special resolution, it is perfectly fine. Everything is good to go. But however, if the resolution fails, the resolution is not passed, in such a scenario, the director would have to refund the excess of 2 within 2 years or the period allowed by the company. Let's say the company says that I want this amount within 1 year. So within 1 year, the director has to refund the excess of 2. Till the time he refunds, he has to hold it as a trustee on behalf of the company. I hope that is very clear, guys. Yes. Next. The company shall not waive the recovery of any sum refundable to it under subsection 9 unless approved by the company by special resolution within 2 years from the date the sum becomes refundable. The company cannot say, boss, you don't need to pay me the two. I am a generous company. You don't need to pay me the two. No, the company cannot say it. The company has to have a special resolution approved by the members within 2 years from the date the sum becomes refundable. Let's say let's say the sum is refundable 1 year down the line. So from that 1 year, you have to see 2 years. Within that 2 years, if the company is able to pass a special resolution, they can waive the amount from the director. I hope that is clear. Next, provided that where the company has defaulted in payment of dues to any bank or public financial institution or non-convertible debenture holders or any other secured creditor, the prior approval of the bank or public financial institution concerned or the non-convertible debenture holders shall be obtained by the company before obtaining approval of such waiver. So in addition to the special resolution within 2 years from the date the sum becomes refundable, you will also have to get the approval of the financial institution where there is a default in the company's end. I hope that is also clear case. Next, in case where Schedule 5 is applicable on grounds of no profits or inadequate profits, any provision relating to remuneration of any director which purports to increase or has the effect of increasing the amount thereof, whether the provision be contained in the company's memorandum or articles. So this is omitted now. This is not applicable. This provision is not applicable right now. It was removed, I think, in 2017 itself. So you don't need to focus on this now. So next, every listed company shall disclose in the board's report the ratio of the remuneration of each director to the median employee's remuneration and such other details as may be prescribed. So guys, if you open any listed company's annual report, you will find this case because every listed company has disclosed this. It is compulsory for every listed company to disclose this. You will find that they will say that this is the median employee's remuneration. This is our director's remuneration. The ratio is so and so. So the ratio is very high usually. So that is that. Yes. Next, where any insurance is taken by a company on behalf of its managing director, full-time director, manager, CEO, CFO, or company secretary for indemnifying any of them against any liability in respect of any negligence, default, misfeasance, breach of duty in relation to the company, the premium paid shall not be treated as part of the remuneration payable to such persona. So like, let's take the same example again. Let's say the 11% comes to 11, but let us say the remuneration paid comes to rupees 13, out of which rupees 2 is in relation to insurance premium, which is included. So in this case, you should not be including the 2. You will say that the remuneration is 11, that is 13 minus 2 equal to 11, and it is equal to 11, that is the maximum limit, so it is within the limit. But however, if the person is proved to be guilty, the premium paid shall be treated as a part of remuneration. Let's say the director was guilty of any offense, and due to which the premium had to be included. So in such a scenario, the remuneration would be 13, and it would be greater than 11. And again, you need to be obtaining a special resolution, and if it is not obtained, the sum has to be refunded, as we had read above, right? I hope that is clear. Next, subject to the provisions of this section, any director who is in receipt of any commission from the company and who is a managing or whole-time director shall not be disqualified from receiving any remuneration or commission from any holding company or subsidiary company of such company, subject to its disclosure by the company in the board's report. So basically, what they are saying is a director who is in receipt of any commission from the company, and like let's say there is a managing director or whole-time director in our company. So let's say the managing director or whole-time director is receiving a remuneration or commission from the holding company or subsidiary company of our company. Let's say we are company A. Let's say H is our holding company. Let's say S is our subsidiary company. Let's say the director is an MD or WTD in our company. Let's say he is also a director in our holding company and subsidiary company. Let's say he is receiving a remuneration and commission for his directorial services in those companies as well. Is that allowed? Yes, it is allowed if the company discloses the same in the board report. I hope that is clear. Next, if any person contravenes the provisions of this section, he shall be punishable with fine, which shall not be less than 1 lakh rupees, but which may extend to 5 lakh rupees. I hope this is clear. The auditor of the company shall in his report under section 143 make a statement as to whether the remuneration paid by the company is within the limit, and if it is in excess of the limit, and if it is in excess of the limit, the details in relation to the same. So as I told earlier, we will look at a real life audit report, and I start off this lecture itself by saying that managerial remuneration has a direct hit on your audit report, which is why it is very, very, very critical. So we'll look at this towards then. Next, on and from the commencement of the Companies Act and on any application made by the central government which is pending, the company shall within 1 year of the such commencement obtain the approval in accordance with the provisions of this section as so amended. Okay, so this is not really important. So next, since we were referring to sitting fees, I told you there is a maximum limit for sitting fees. Let's look at that. A company may pay a sitting fee to a director for attending meetings of the board or committees thereof, such sum as may be decided by the board of directors thereof, which shall not exceed 1 lakh rupees. So the maximum sitting fees you can pay per meeting is 1 lakh rupees, right? I hope that is clear. Next, provided that for independent directors and women directors, the sitting fee shall not be less than the sitting fee for other directors. Let's say I pay a sitting fee of rupees. Let's say I pay a sitting fee of rupees 90,000 to my MD. But however, I'm paying a sitting fee of only 80,000 to my independent directors and women directors. Is that allowed? No, it's not allowed. Because the act wants to give a special status to independent directors and women directors, because independent directors are people who are independent of the company. They are highly skilled people. They have a lot of professional knowledge and experience in that field, due to which they have been appointed as independent directors to the board. So they want to respect them, and they are saying, boss, if you are giving 80,000 to your MD, for example, as sitting fees, you should at least be giving 80,000 to your independent directors and women directors. If not more, give them 85,000, give them 90,000, or give them even 1 lakh. Just ensure that it does not exceed 1 lakh, right? I hope that is very clear. Next, how to calculate sitting fees? Very, very simple, Max. Just take the number of meetings attended by each director and multiply with the sitting fee fixed for each director. Let's say let's say I have one woman director in my company. Let's say the sitting fee for the woman director is 90,000. Let's say the women directors attended 5 meetings throughout the year. So 90,000 into 5 will be 4,50,000 will be the sitting fee for the woman director. Similarly, for each of the directors, take the sitting fee assigned to them, multiply it with the number of meetings they have attended throughout there. How do you know the number of meetings attended by the director throughout there? Obvious. You can just go to the minutes of the meeting. You can just see the directors who are present in the minutes of the meeting. If any director is absent in that meeting, they should not be getting sitting fee for that meeting. I hope that is clear, guys. Just ensure that when you're doing the calculation, right? Cheers. Next, guys, this is very important. How to factor ESOP in managerial remuneration? And for managerial remuneration, what is the remuneration defined in managerial remuneration, sir? I don't understand. We never discussed about that, right? Now we'll discuss about that. Just going up a bit, I'll just show you remuneration. So remuneration also has a definition in Companies Act. So it is defined in section 2. I don't remember the clause. So it is saying remuneration means money or its equivalent for services rendered and includes perks defined under Income Tax Act. Yes. So this is where the definition leads us to. Yes. Yes, guys. So when you go to, all of us will have read our salaries chapter as a part of CA Inter. You know what is to be included in salary, what is to be excluded in salary. If an item is to be excluded in salary, it will not be forming a part of remuneration for the purpose of comparison with the maximum limit. I hope it is very clear. So those items I am sure you all would know, but there is a tricky item, ESOP. And this is where clients also tend to make mistakes while including in the remuneration, which you should be careful about, which is why I'm going to be educating you on the same, right? Just give me a moment, guys. Just give me a moment. Just give me a moment. Hey guys, so moving on to ESOP part of it, as we were discussing in the last video. Just give me a moment. Yep, it's coming down a bit. Just a moment, guys. Just a moment. Yes, guys. So as I was saying earlier, this is a very common mistake which clients do while computing your managerial remuneration. So this is something you need to be really careful about, right? So just coming down here. So you have to include ESOP in your remuneration only and only when your options are exercised. So your ESOP being included in your managerial remuneration, that question won't arise when your options are not even exercised till date. It will arise only when your options are exercised. Please, please, please just keep that in mind. So we've also discussed an example here. We've taken this right from the income tax website. So basically, what is it saying? How do we compute this? So to give you in simple terms, my computation, if I have to give you a perspective, is, so basically, if I have to give you a perspective, I have to take the fair market value. Just a moment, sorry. I'm just typing it here. Maybe it'll be better. Just type it here. No, I'm not able to do it. So basically, I just explain it, guys. So basically, what you have to be taking in relation to your ESOP is your fair market value on the date of exercise of the option minus your agreed price. That is, you would have agreed a price with the company for the option, right? Which would have been concessional in nature. That multiplied by your number of options, that is the value that should be included in your remuneration. I hope that is very clear, guys. Just repeating once more, your fair market value on the date of exercise of option minus your price agreed with the company multiplied by the number of options. That should be the amount that should be included in your remuneration for comparing with the maximum threshold. I hope that is very, very clear, guys. Let's look at some scenarios. When the shares are listed on one stock exchange on the date of exercising ESOP, average of the opening and closing price of the share on the date of the stock exchange. Let's take a company like ITC. Let's say ITC is only listed on NSE for assumption purposes. So in that scenario, we have to take the opening price plus closing price on NSE by 2 on the date of exercise. I hope that is clear. Let's say the shares are listed on more than one stock exchange. Let's say ITC shares are listed on both NSE and BSE. Let's say the highest trading volume happens in BSE. So you have to take the average of opening and closing price, opening price plus closing price divided by 2 on ITC or on BSE, where ITC shares are traded, because the higher volume happens in BSE, and that should be the fair market value you would be considering for the computation. Next, where on the date of exercising the ESOP, there is no trading in shares in the stock exchange. For example, let's take today, 19th of October. So today it is a Saturday and the stock market obviously is not functioning. So let us take today. So basically what they're trying to say is, since on Saturday a stock market would not be functioning, so the closing price of the share on the stock exchange on a date closest to the date of exercising of the ESOP and immediately preceding such date. So basically we have to take yesterday's fair market value, that is 18th of October, because 18th was a Friday and the stock market was pretty much working. Next, the closing price of the share on the stock exchange, which records the highest volume of trading in such share. So basically this is, again, if let's say the share is listed on two stock exchanges, NSE and BSE, and let's say the higher volume happens on BSE, you have to take the average, you have to take the closing price on BSE and not on NSE, because it is trading in more than one recognized stock exchange, and the higher volume of trade happens in your BSE and not in NSE. So that is how you have to proceed here. And here, just keep in mind, it is a closing price. However, above it is the average price. I hope it is clear, guys. Like basically, when you have to take it on the same day, it will be the average price. But when you have to take the closer date, it will be the closing price. Just keep this in mind, guys, because the closing price will be a more accurate representation, right? Because when you're taking the average price, like let's say today, when you're taking the average price of yesterday to arrive at today's fair market value, that would not be a right reflection, right? Because when you're taking the average price, you'd be taking the opening plus closing by 2. But closing is more closer to today's date, right? Because closing would be today's opening. So that is how things work, right? So that is why the section is telling us to take the closing price. That is the income tax act for the computation of the perquisite. Next, where shares are not listed on a stock exchange. That is where the share is not listed on a stock exchange. This is a very, very rare scenario, but again, let's just discuss this. The date of exercising of the ESOP, that is the value of the share determined by the merchant banker. So basically, you have to take the valuation from a merchant banker on the date of exercising ESOP or any date earlier than the date of exercising of the option, not being a date which is more than 180 days earlier than the date of exercising. So basically, if I am exercising the option on 19th October, it cannot be, it can be within 180 days. That is less than or equal to 180 days. That is, let's say 19th April is like exactly 180th day. You cannot do it on now. You cannot basically do it on 18th April, because 18th April would be the 181st day. It is not exactly 180 days. I'm just explaining for an example purpose. You cannot take the 181st day. So the maximum gap would be 180 days for the purpose of this. I hope this is clear, guys. Next is coming down. So they have explained an example here. ABC India Private Limited issues ESOP to Mr. B during the financial year 24-25. Calculate the value of perquisite based on the following data. Date of granting of ESOP, 1st April 2022. Vesting period, 1st April 2022, 31st March 24. Okay, so let's see the financial years that are falling here. 22-23 is falling here. Next year, 23-24 is falling here. So do you include any ESOP in 22-23 and 23-24 financial year? No, because there is no exercise. It is merely the vesting period that is going on. There is no exercise that has taken place, because the exercise is taking place on 10th May 2024, which is in the financial year 24-25. So only in financial year 24-25 would an ESOP component be included in the managerial remuneration computation. I hope that is very, very, very clear, guys. So they are saying the fair value as on March 31, 2022 is 6,000. Fair value on May 10, 2022. I think this should have been 2024. I think it was a typo here, because 2024 is the day on which the exercise happens. So number of ESOPs exist 100. Predetermined price to be paid by the employee to the employer. So basically we take the fair market value on the date of exercise, which is May 10, 2024, minus the price which is paid by the employee to the company, because that is the benefit is getting, right? Because if he had gone today on May 10, 2024 and purchased in the market, he would have had to pay 6,500. But he's only paying 500. So he's getting a benefit of 6,000 into 100, which comes out to rupees 6 lakhs. I hope that is very clear, guys. So this is the amount that should be included. Let's say my 11% of net profit comes out to rupees 11 lakhs. Let's say my director has a remuneration of rupees 6 lakhs. So sorry, let's say my director has a remuneration of 7 lakhs excluding ESOP. So when I have to include this 6 lakhs, it would be 7 lakhs plus 6 lakhs, 13 lakhs. But my 11% comes to only 11 lakhs. So this is exceeding the limit. Again, I have to get a special resolution. And if the special resolution fails, then the 2 lakhs has to be kept in trust till it is refunded. I hope it is very, very clear, guys. Yes, next. Audit report extract. So I've taken a real life audit report of a company where this is the language they've given. The company has paid or provided for managerial remuneration in accordance with the requisite approvals mandated by the provisions of section 197 read with schedule 5 to the act. Okay, let us take the scenario which we were discussing just now. Let's say the 11% comes to 11, but the company wants to pay 13. So and let's say today, let's say the audit report is going to be signed today, but the general meeting for the approval of the excess has not been held on the date of the sign of the audit report. So what would happen is, this would be the wording that would be coming. The company has provided for managerial remuneration subject to the approval of the shareholders in this general meeting, mandated by the provisions of section 197 read with schedule 5 to the act. Why is this language used? Because guys, if my shareholders do not approve the excess of 2, what would happen is the director would have to refund the amount back to the company. So that is why we are saying subject to the approval, because as on the day of signing the audit report, the general meeting has not been held, right? I hope that is very, very clear, guys. Suppose, let us say the general meeting was held before the date of signing the audit report, and let's say the special resolution failed. In such a scenario, the director would have to refund the amount, right? So in this scenario, what the company would be, the language in the audit report would be is that the company has provided for had provided for managerial remuneration in excess of the limits prescribed under section 197, and the excess amount is held in trust by the director. That would be the language applying in the or coming in the audit report, and we would have to also consider the other implications on the audit report because of this. I hope that is very clear, guys. Next, now we come to CSR, guys. So CSR also talks about net profit computation. So what does CSR say? Net profit means the net profit of the company as per the so it's saying, we just come here. So even the CSR computation is on the basis of section 198, but there are two differences in this computation which are explained in the CSR rules. So you need to go to the CSR rules to see these two differences in the computation. Because if you go to main section 135, I'm not pasted the extract here, but if you're able to open section 135 in the MCA site or any other site like Taxman, you will see that section 135 also says that your net profit has to be computed in accordance with section 198. But your CSR rule says that it has to be computed in accordance with section 198. That is obvious, but there are two exceptions. Let us discuss the logic for these two exceptions, guys. But shall not include the following, namely, any profit arising from any overseas branch or branches of the company, whether operated as a separate company or otherwise. Let's say ITC is an Indian company. Let's say ITC has a branch in Hong Kong. Let's say there are some profits from the Hong Kong branch, which will obviously be in ITC's financial statements, right? Because ITC is the Indian entity, right? And they have a branch which is outside of India. So what would happen is, let's say there is a profit of 20 coming from the Hong Kong branch. So this profit of 20 should be removed from the net profit. Let's say ITC has a total net profit of 120. So this 20 should be reduced from the net profit. 120 minus 20 equal to 100. So 100 should be the net profit that is to be considered for the CSR purposes. I hope that is very clear. Next, any dividend received from other companies in India which are covered under and complying with the provisions of section 135 of the Act. Let us discuss the logic for this below. Next is something in relation to foreign company, which is not of much relevance, but however, if you want me to discuss that as well, do comment down below. I'll maybe do a YouTube short on that, right? Let's discuss the logic. Let's say company A is there, let's say company B is there. Let's say both of these companies exceed the prescribed limit for CSR, and hence CSR is applicable on them. Maybe the paid up capital, or maybe the turnover or the net profit. Whatever they exceed this, due to which CSR is applicable on them. Let's say net profit of company A is rupees 100. Let's say company A pays a dividend of 100 or rupees 10. What would be the entry for dividend? Guys, remember this, dividend does not impact your profit and loss account, because dividend is not a charge, dividend is an appropriation of profit. Please keep that in mind. So the entry would be retained earnings account debit to the extent of 10 to bank account 10, right? I hope that is clear. Because this 10 wouldn't have been deducted while arriving at the net profit. Let's say net profit is equal to 110 for company B, which is including a dividend of rupees 10. So the entry that would be passed here is bank account debit 10 to dividend income 10. But for CSR purpose, what the CSR rules are saying is that you have to take the net profit as 100 for CSR purpose. That is what the rule is saying. So you have to take the net profit as 100 for CSR purpose and not 110. The simple logic being, since company A, which paid a dividend of 10, they did not get a deduction benefit in the net profit. So they are anyways going to incur CSR expenditure on this 10. They are anyways going to incur CSR expenditure on this 10. But even if company B is going to be incurring CSR expenditure on this 10, it does not make any sense, because the CSR is being doubly applied on both these places, right? Because since company A is not getting the deduction, this 10 will also be subject to CSR. And if company B also does not get the benefit, both there will be a double CSR application, right? Which is not right. Which is why the section is saying that you take 110 minus 10, because the CSR has already been applied on the 10 here. That is because this 10 wouldn't have been deducted while arriving at the net profit. That is why this benefit is offered. I hope this is very, very, very clear, guys. Okay. So now you might be having a question as to if the CSR computation is the same, what is the difference between my CSR computation and my managerial remuneration computation? Okay, let's take a sample financial year. Let's take financial year 24-25. Let's take this scenario. So what would happen is for managerial remuneration, we will take the profit and loss, profit before tax of financial year 24-25 as the starting point and make the adjustments above which we discussed in section 198 and arrive at the net profit for managerial remuneration purpose. But for CSR, you would have to be taking the P&L of the preceding 3 years. You would not be taking 24-25 financial years numbers here. You would take 23-24, 22-23, and 21-22 here, right? I hope that is clear. So in this scenario, what would happen is you would be taking the 23-24, 22-23, 21-22 average. So you will be doing 23-24 net profit plus 22-23 net profit plus 21-22 net profit divided by 3, and you will be arriving at that number, and you will multiply that number with 2%, right? I hope that is clear. You will be multiplying that with 2% because that is what is set out in section 135. I hope that is very clear, guys. So that is what you will be doing to arrive at your net profit. So basically what will happen is, if I have to give you in simple terms, whatever computation you are doing for managerial remuneration in financial year 24-25, that will form part of CSR computation in financial year 25-26. Because when you go to financial year 25-26, you will take 24-25, 23-24, and 22-23 for CSR, right? Provided these two adjustments are not there. If these two adjustments are not there, your managerial remuneration for the current year will be the same for the CSR computation of the next year. I hope that is clear. I hope you understood what I'm trying to say, guys. Yes. So I was talking about impairment loss, guys. Yes. So I will explain the context of impairment loss and its relevance here. So why is impairment loss important here, guys? I'll just come here. So we were discussing about loss of capital nature. If you just remember, I'm just going up a bit to section 198, and let's just decode this right away, right? Just coming there, just a moment. Loss of capital nature. So what they're trying to say is impairment loss is definitely a loss of capital nature, right? Because your capital asset is subjected to a loss due to which you are booking an impairment charge in your books of accounts. So what we do is, for the purpose of a CSR, even though it is not very clearly given in the section that your impairment loss in accordance with the AS or Ind AS is a loss of capital nature, for our CSR computation, we conservatively add back the amount. We conservatively add back the amount of impairment loss. Just a moment. We conservatively add back the amount of impairment charge, because when we add back the amount of impairment loss in our CSR computation, because your impairment loss would have been reduced while arriving at a net profit, right? You add it back, because when you add it back, what would happen is your CSR amount is going to be increasing, because you would be, since your net profit is higher, your CSR contribution will be 2% of that higher amount to the extent of an increased impairment charge, right? So that is why it is important while doing this. So this is a stance which most of the firms and most of the companies tend to take on a conservative basis for the purpose of CSR, because they don't want to be doing an under contribution, right? Because when they take a conservative stance, no one is going to come and ask them and say that you have underfunded your CSR. Everyone is going to be like, okay, you've contributed this, there's no problem. But when you do not add back your impairment loss for your CSR computation, there is a risk that regulators might come and interpret the section in this way and say that you have under contributed, and this might lead to penalties. This might trigger other issues, right? So to be on the safer side, we just add that back in our CSR computation. I hope that is very, very clear, guys. And guys, just a moment. Yes, guys, so we have approached the end of this video. I hope the discussion was very healthy and it was very, very clear. Guys, in case you have any doubts, do comment that down below and I will definitely respond to the same. And if you love this video and if you feel that any of your juniors or any person whom you know is going to be entering into the audit domain would find this useful, please do share it with them and do hit that subscribe button. More content is growing on its way. And if you want any particular financial statement line item explanation, do comment that down below and I will do a video on the same shortly. So guys, keep learning, keep growing. Thank you so much for your support. Keep supporting and enjoy your weekend. Thank you so much. Cheers. Bye.